HIMS and Hers Health Inc. is currently trading at $34.71 per share, showing an intraday upward movement of $1.09, which translates to a gain of roughly 3.24% at this very moment. When you look at that green number flashing on your screen, the immediate expectation is that this is just another volatility swing in a high beta growth stock, perhaps driven by a general tech rally or some vague optimism about interest rates. The common narrative suggests that HIMS and Hers is merely a middleman, a digital storefront selling generic erectile dysfunction pills and hair loss foams that is currently enjoying a temporary sugar high from the weight loss drug craze, a craze that many assume will end the moment big pharma giants like Eli Lilly and Novo Nordisk resolve their supply chain bottlenecks. That is the expectation, a precarious business model built on a loophole that is about to close. But the reality, which we need to examine closely today, is far more complex and suggests that this company is systematically building a regulatory and logistical fortress that the market is only just beginning to understand. The recent 3% move isn't just noise. It is a reaction to a company that is aggressively signaling its own undervaluation through a massive $250 million share repurchase program, while simultaneously hiring former FDA executives to navigate the exact regulatory minefields that bears say will kill them. The reality is that HIMS and Hers is transitioning from a telehealth marketing company into a vertically integrated, personalized healthcare infrastructure that is becoming increasingly difficult to dislodge. To understand why this stock is moving today, we have to look beyond the headline price of $34.71 and look at the volume and the context. We are seeing volume that indicates a battleground. Bears are betting that the FDA's shortage list updates will wipe out the company's lucrative compounded GLP-1 revenue stream, while bulls are looking at the new Labs initiative and the appointment of Deb Autor, a former top FDA leader, as chief policy officer. This is not the behavior of a company that is planning to fold its tent when the supply shortage ends. When you open your Robinhood stock trading app or check the charts on your Fidelity mobile app, you might see the price volatility and assume instability. However, if you look at the institutional flows, you see a different story. Smart money is beginning to realize that HIMS and Hers has built a customer acquisition engine that rivals the efficiency of software companies, not healthcare providers. The price action we are seeing right now is a tug-of-war between the fear of regulatory crackdown and the greed for a company growing revenue at over 40 to 50% year over year while maintaining gross margins above 80%. That margin profile is unheard of in traditional healthcare. It is closer to what you would see in a high-flying SaaS stock like NVIDIA stock or even in the early days of Facebook. The market is trying to decide if HIMS is a tech company or a drug distributor, and that identity crisis is where the opportunity lies for the individual investor. Let's talk about the elephant in the room, which is the weight loss drug segment. This is where the tension between expectation and reality is sharpest. The expectation is that once the FDA declares the shortage of branded semaglutide over, HIMS and Hers will be forced to stop selling their compounded versions and their revenue will collapse. This is the bear case you will hear if you browse through SoFi Invest forums or read surface-level analysis on various investment sites. However, the reality is that HIMS and Hers is pivoting toward personalized dosages. Under the 533B compounding regulations, if a patient has a specific medical need that the mass-produced branded pen cannot meet, such as a non-standard dosage to manage side effects, a compounding pharmacy can legally create that medication indefinitely, regardless of whether the branded drug is on the shortage list. That is a critical nuance. By launching a platform that allows doctors to prescribe exact micro-adjusted dosages based on patient tolerance, HIMS and Hers is creating a legitimate, permanent lane for its compounded products. They are not just filling a shortage gap, they are creating a superior product experience that big pharma's one-size-fits-all injector pens cannot match. This strategy explains the recent hiring of high-profile regulatory experts. You do not hire a former FDA leader if your business model is a scam. You hire them to help you construct a compliant, long-term pathway for personalized medicine. We also need to discuss the Amazonification of healthcare that HIMS and HERS is executing. When you think about how Amazon started by selling books and then built a logistics empire, HIMS started with hair and ED pills and is now building a massive pharmacy fulfillment network. They are effectively cutting out the friction of the traditional healthcare system. Think about the last time you tried to see a specialist. You had to call, wait 3 weeks for an appointment, drive to the office, sit in a waiting room, pay a copay, go to a pharmacy, wait in line, and hope your insurance covered it. HIMS and HERS compresses that entire multi-week nightmare into a 20-minute experience on your phone. This is why their subscriber numbers are exploding. It's not just about the drugs, it's about the user interface of healthcare. In a world where people are used to the instant gratification of ordering dinner on DoorDash or trading stocks on interactive brokers, the traditional healthcare model feels archaic. HIMS and HERS is bringing the user experience of Silicon Valley to the regulated world of medicine. This is a powerful moat because once a customer gets used to that convenience, they rarely go back to the old way. This stickiness is reflected in their retention numbers, which remain robust despite the fears of churn. Furthermore, the recent announcement of a $250 million share buyback is a massive signal that management believes the stock is severely undervalued at current levels. Companies that are worried about cash flow or future regulatory shutdowns don't spend $250 million buying back their own stock. They hoard cash. This move is a direct challenge to the short sellers. It tells the market that the company has sufficient liquidity not just to survive, but to shrink the float and drive up earnings per share. When you see a company with a market cap around $8 or $8 billion authorizing a buyback of that size, it acts as a floor for the stock price. It gives investors on platforms like Fidelity Investments or Schwab Intelligent Portfolios a sense of security that there is a committed buyer of last resort, the company itself. This capital allocation strategy is usually reserved for mature, slow-growing cash cows, so seeing it from a hypergrowth company like HIMS and HERS is a unique convergence of growth and value tactics. It suggests that the management team sees a disconnect between the share price and the intrinsic value of the business that the public market is failing to appreciate. Now, pause for a second. I want you to think about your own portfolio. Do you hold any shares of HIMS and HERS, or are you watching from the sidelines? Comment below how many shares of HIMS and HERS you currently hold, or if you are waiting for a lower entry price. Also, do you think the FDA will eventually crack down on compounding pharmacies, or is personalized medicine the future? Let me know in the comments. I really want to gauge the sentiment out there because it seems like retail investors are often more bullish on the product than the Wall Street analysts. Moving back to the analysis, we have to look at the labs announcement. HIMS and HERS is rolling out a service to test for various health markers. This might seem boring compared to weight loss drugs, but it's strategically brilliant. It shifts the company from being a pill mill to a holistic health management platform. By gathering blood work and biological data, they can offer a wider range of preventative treatments, increasing the lifetime value of each customer. If they know your cholesterol is high or your testosterone is low, they can cross-sell you treatments before you even know you need them. This data-driven approach is what separates them from a standard online pharmacy. It's comparable to how Netflix uses data to recommend movies, or how SoFi Active Investing uses your spending data to recommend financial products. Data is the new oil in healthcare, and HIMS and HERS is gathering a lot of it. This creates a high switching cost for the user. If HIMS has your history, your blood work trends, and your medication preferences, you're less likely to switch to a competitor just to save $5 a month. Let's look at the financials and the value argument. Despite the stock being up significantly over the last year, it still trades at a reasonable multiple relative to its growth rate. If you look at the PEG ratio, price to earnings to growth, it is often flashing undervalued depending on which analyst estimates you trust. Most high-growth tech stocks trade at 10 or 20 times sales. HIMS trades at a much more modest multiple of sales, largely because the market treats it as a healthcare stock rather than a tech stock. But as we discussed, their margins are tech-like. This misclassification is a classic arbitrage opportunity. If the market eventually re-rates HIMS and HERS as a consumer tech subscription business rather than a generic pharma distributor, the multiple expansion alone could drive the stock significantly higher